Now, as we said in the last segment, or the end of the last segment, we wanted to look at some of the leading indicators going forward. And here we want to kick off with the further weakness for December. Composite, looking at flash PMI, the composite was down to 44.6 versus the estimate of 46.9. Manufacturing fell to 46.2 versus the estimate of 47.8. Service fell to 44.4 versus the estimate of 46.5. Downturn in business activity was the sharpest since May 2020. And that's where we continue to see a lot of these slowdowns, with big business conditions are worsening as 2022 draws to a close, which again leads more to the problems that we see coming as we head into next year. And then the weaker demand should take some pressure off supply chains, but it doesn't mean that you're going to see a lot of that pressure in general, because there's other input costs that are remaining sticky that we've been talking about being the underlying problem. So then when you look at, again, it just in context, the 47.8 versus the 46.2, but new orders, see the drop in new orders. This is the one that's the most concerning. And again, leading back to our conversations around Q1 of that big new orders drop. And because that's what new orders are coming in. What should be filled in Q1 is contracting. And that's where we see a lot of these follow-on problems. Services, coming in below, you can see lower high, coming back down. But then input prices for manufacturing, it's obviously crashed, but it's still at 54.5. So new orders are at 43.5. Input prices coming down, but still expanding. They're just expanding at a slower rate, which again leads back to our conversation around disinflation, but not seeing that drop, which is why we see more of that stagflationary backdrop, because new orders will kind of bottom here, still stay slow, while input prices also kind of flatline right at these levels, with some of that support in that period at this point. Then you look at service input prices at 58.3. So you're still in expansion across the board, but current business activity, the diffusion index from New York, you're seeing contraction. You're almost at negative 20, but your service input prices are at 58.3, still the highest, obviously, going back through 2016. Even after it's fallen from 81 to 50 to 58, you're still at the highest it's been since, going back since ever, but, going back to 2020 when you first started to see this spike. So that's why when you look at year on year, sure, it's better than 2021, but it's still bad compared to previous times, which, the pre-COVID, which is why we think there is a lot of that staying power, because these two pieces really look at that stagflationary backdrop where clearly economic activity is falling while input prices have come down, but still remaining elevated in expansion. And all of that pre-pandemic commentary, when you look at labor force participation trend versus current conditions, well, missing participants, missing male, missing female. There is a big drop that should be moving on this normal kind of flatlining trajectory on the pre-pandemic trend, and it's just not there. And because of retirements, because of shifting demographics, we're not going to see that number close that gap, which is going to keep wages elevated, job market tighter than it should be, given the depth of the slowdown in activity. And that's, again, a key component with labor being one of the biggest input costs for a lot of companies. So Philly Fed manufacturing expected at negative 10, came in at negative 13.8. Philly Fed manufacturing new orders coming at negative 25.8. Again, all of those things showing that slowdown. Then when you look at manufacturing shipments, came in at negative 6.2. Number of employees, it finally turned negative to negative 1.8. So all of those pieces, all of those charts show that slowdown, which is going to crop up on a more national economic level. I was about to say global, I meant national economic level, with that slowdown in data, because Philly's a great leading indicator. And as the national side slows, well, that has a big impact on onto the global front, because the U.S. is the largest buyer in the world, and north of 15, let's call it 15, 16% of all consumption globally, which is going to weigh on emerging markets. It's going to weigh on that piece, which is why we remain so concerned. Then you look at prices paid, though, at 26.4. So all of this is getting worse. Prices received, 24.3. So on an economic level, it's all negative now, but it's still expanding on a price level. Again, that stagflationary backdrop. Expected new orders did have a nice bounce to 13.6. And that's why we're expecting that there's a certain amount of hope within the expected new orders, because that's what they think is going to come based on seasonality. There's usually a bounce in January as people look to refill after the holiday push. We just don't think that really comes to pass. And you can see how lumpy it's been over the last couple of months with these big swings up and down, because it's been hard to calculate because things aren't where they are, creating that volatility. Now, Empire State Manufacturing came in, expected at -1, came in at -11.2. Again, moving firmly negative. Average employee work week, -4.5, but prices paid bounced. Again, that stagflationary backdrop, that conundrum that we continue to see in general. So then when you look at prices received, 25.2, we're not seeing a lot of this slowdown. Then if you look at the Empire State Manufacturing expected business conditions, nice little bounce, but you can see similar to Philly, very lumpy, going back and forth. So we don't see a huge adjustment, and realistically we see more of that drawdown over time. And the real estate is a big piece of that. So November existing home sales plunged -7.7 versus the estimate of -5.2. Monthly supply moved up to 3.3, and median selling price was up 3.5% year on year to 370,700. The severity of the current U.S. housing market slump in one chart on the housing side, housing activity index lower than after the burst of the subprime bubble. And if you look at U.S. housing activity during 2008, peak levels, it was -19. Now you look at U.S. housing activity, it's at -23.5. So where are home prices going to go? As home prices fall, people will feel less wealthy, and they'll be more, it'll prompt them to spend less. And then at the same time, you paid crazy levels because we had a huge amount of activity of an exchange in 21 and 22, 20 into 21, and then at the beginning of 22. And those people have a lot of equity in the house that they can't get back, but it's affordable. And that's where I think you're going to see some of these backdrops. Total multifamily homes under construction. The number of multifamily homes under construction has risen to the highest since December of 1973. So whenever you hear this concept of, we have a housing shortage, it's like, well, the demographics show that we have a shrinking prime age. We have a shrinking household, which we're going to show in a moment, in terms of less children, less families, more people living alone. So realistically, we're moving in the wrong direction for families as more construction comes online. And then November saw a move higher in the spread between housing units completed minus those under construction, but the difference remains deeply negative. So there's still a ton of capacity in the hopper to be completed. Some of it's family units, some of it's single, but there is a lot of volume coming in. So not only do you have less buyers, but now you have a new slug of supply coming on, which again is going to bring prices down further. New privately owned housing units under construction, units in buildings with 5 or more units, is at a record. It has now taken out. So again, there's different ways to categorize it, but you can see here, this is a massive surge in building, which as we've been saying is why we struggle when you hear about this, there's going to be a supply shortage. It's like, well, there's a lot of new supply coming on to meet that new demand. And then when you look at November housing starts, came in at -0.5 versus the estimate of -1.8. Building permits came in at -11.2 versus the estimate of -2.1. Level for permits has fallen to the lowest since June of 2020. So again, building permits is dropping because you still are sitting on a ton of permits. the starts are going up, but why am I going to go get a new permit if I already have all of this capacity? Plus, who am I selling this to? And then where are the buyers? Prospective buyer traffic portion of the NAHB housing market index was unchanged at negative at 20 in December and firmly recessionary and with a massive deterioration from the peak, which is what we've been talking about. While headline housing market index fell in December, future sales component ticked up, but remains in deep recessionary territory. If you are still in recession denial, which I love this True Insights of, then don't look at the chart below. The U.S. building permits are falling off a cliff. This happens every time in the run-up to the next recession, which we've been highlighting and talking about aggressively. Looking at home builder sentiment in year-on-year terms, we have never seen this kind of change for the housing market. And if you look going back to 1985, again, looking at that yellow line, you see it negative 53. And I had a great conversation with a LP in my PE fund, and she kept saying, well, you know, I'm hearing something very different. And I'm like, look, this is what the data shows. You know, I have never met a real estate agent that isn't bullish. I've never met a developer who isn't bullish. So, but then they get bearish all at the same time. And I was like, you have to look forward. And that is, I think, really picked up quite well, and described, visually in this chart. So then housing continues to move down. December housing market index fell to 31 versus the estimate of 34. Index at risk of falling below COVID lows. The NAHB chief economist notes that we may be nearing the bottom of a cycle for builder sentiment, but it doesn't mean you bounce. And if anything, I would say that, again, being optimistic there, I don't think it bounced. I think you could get a short-term bounce, sure. You could kind of bump along sideways, but I think just as we had in 2005, into 2006, you had that bounce and then that continuation to the downside, and I think that's really what we're looking at. Active listings still on the low end. And again, people don't want to sell homes into this. So then the new home listing is down 17.2% because you have people looking at this and say, well, a year ago, I could have sold my house for double. I'm just going to sit and wait. And the problem is people that have to move versus people that, maybe wanted to move, that now changes and you get stuck kind of where you are. One unit housing starts dropping, but that 5+ housing starts. So you're seeing that slowdown in the smaller housing starts, and you're seeing an increase in 5+ because you can spread your cost around 5 versus 1 or 2. So when you look at it, it makes sense if you're a builder. It's like, all right, well, I was going to build a 4-unit building, 2 and 2. Well, maybe I'll just do 4 and 4, just do 8. Because then I can, even though my costs are higher, costs have come down a bit, I can spread my costs across more people. Then that becomes a little bit easier, more palatable when you're looking at some of that revenue. U.S. 1-unit building permits, again, permits are dropping. Same with the 5+, because why would you do it? You have all these permits. So let's start construction on those. The market is going to reward you for it. So let's do that instead of the 1-unit permits. Let's try to focus more on that side. Home buyer affordability, fixed mortgage index, new historic low. So the Fannie Mae is reporting that 79% of Americans think it's a bad time to buy a home. That's historic housing pessimism, a record. Suggests that housing downturn will get even worse into spring 2023. So you have the affordability index at a new historic low, and people saying, nope, this is the worst time ever to buy. Well, you're going to have to see affordability get better before you see people buying. And there's a lot, to unpack within that. The demographic decline of America, first time ever. There's more people living alone than households with a child, which is bad news for the future of society and the housing market, as we've been saying on a lot of different levels. Aging of U.S. population is a big problem. Right now, seniors occupy 36 million housing units in America, a huge increase in the last decade, but there's only 16 million housing units occupied by young adults under 30. Same number as in early 1980s. Again, that unfortunately, and I'm not being morbid by saying this, you're more likely to die over the age of 65. So as those people start to pass away or go into nursing homes or go live with family because they can't take care of themselves, there's a lot of units coming online. And that's where I struggle with this view that we have this underlying shortage. And to kind of wrap that around in a bow, aging, dying homeowners will create a huge surge in inventory over the long run, likely starting in 23-24, but bigger problem is lack of children. Right now, only 24% of housing units in America have a child under 18 in them. A new record low was set in 2022. So unless we get a bump in this, you're going to, again, that leads to the demographic problem, the child problem, all of the things we've talked about, which makes this difficult when you look at the aging side and just where we are setting up for an economic move over the course of the next, decade, which is why we remain concerned, broadly speaking, of where we sit for the future. So that's what we have for you in the U.S. In the next segment, we're going to go deeper into Europe and some of the things that are happening within that continent.